we're clearly in a bumpier kind of transition phase for stocks. And I certainly think that the easy rallies, if you like, of last year and maybe even some of the beginning of this year, that's kind of gone. So it's not to say the market isn't still in a primary bull trend. I think that is the case, but the returns are going to be much harder to come by, and it's going to be a lot harder ride. The good thing is, though, that hedging is still relatively cheap.
Well, folks, sometimes a monkey wrench gets thrown into the best laid plans. I recorded this interview with Bloomberg's Simon White 2 weeks ago, but due to several curveballs, there just hadn't been space in the schedule to publish it until now. But Simon's observations of growing price volatility in markets and the corrosive effects of higher for even longer interest rates are even more relevant now than when this interview was recorded, due to recent events like last week's market rally and Jerome Powell's guidance that rate cuts aren't coming anytime soon. So, while there may be an outdated reference or two to the swoon that stocks took back in mid-April, this is definitely a discussion worth hearing in full. Enjoy. Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Stubbornly sticky inflation looks to be turning the Federal Reserve's campaign of higher for longer interest rates into higher for even longer. Today's guest warns that, quote, markets are unprepared for price growth that's becoming entrenched. Nor do they appear prepared for bond yields to remain at today's rates, let alone potentially march even higher from here. Remember, it was only a few short months ago that the markets were pricing in 7 rate cuts for 2024. Now it's appearing they'll be lucky to get only 2 or 3, and who knows, they might not get any. Does this mean financial asset prices need to adjust downward in some material way? And will the economy slow faster than expected from here? Perhaps the recent weakness we've seen in stocks is Wall Street's awakening to these potential ramifications. So, for an analyst perspective on the matter, we turn to Simon White, macro strategist at Bloomberg and co-founder of the investment advisory firm Variant Perception. Simon, thanks so much for joining us today, all the way from London.
Thanks for having me again, Adam. Thank you.
Total pleasure, Simon. And I want to thank you for soldiering through the technical issues we had kind of getting this particular video set up. I know you've had to switch to your phone in the background here as a backup here. So thank you for doing all that. Everything looks good. Super excited for this discussion. Lots of questions for you based upon a lot of your recent work. I know you sent me some slides over at the beginning of this, so we'll pull your charts up as need be. But let's kick this off with a general question that I like to ask everybody at the start here. What's your current assessment of the global economy and financial markets?
Well, I'd say thanks again for having me on, Adam. And yes, let's hope the tech doesn't fail us at the wrong time. Obviously, very good question. I think we are in a kind of a bit of a regime shift right now. We've had the last year, I'd say year and a half, certainly all through the rally, where we've had very conducive liquidity situations. And that's really what's kind of thrown a lot of people off the mark in terms of missing the fact that, we're in this bull market in equities. I was very bearish at the start of the bear market, and the market managed to kind of recover faster than I expected it would. But really, there was some very powerful underlying dynamics when it comes to liquidity, how the Treasury operated, how the Fed operated, that meant that you were able to get this financial asset rally in the face of what were, the tightest monetary conditions we've seen in some time. But I think right now we're beginning to see a sort of transition period, and that isn't necessarily a rupture. It doesn't necessarily mean that, the whole edifice is about to cave in, because, the underlying conditions are such that you could make that case. You could probably always make that case, but the market manages to kind of to soldier on. So you know that generally markets go up, the path of least resistance tends to be higher, but when they do fall, it can be very short and snappy affair. So yeah, I think that the rise in volatility we're seeing right now across assets and a number of other things is telling us that we're in a potential regime shift. And that really means that what worked for the last 6, 9, 12 months perhaps is not going to work over the next year or so or longer.
All right. So one of the things that I've talked with a lot of the guests on this program that's sort of been driving asset prices, but also economic growth over the past year and a half has been the net rise in liquidity. in the system, and it's it's something that everybody measures a little bit differently. But those net liquidity flows generally look like they turned positive in October of 2022. And since then, things have been off to the races. So you're not the only person, who expected had a more bearish forecast a year ago that kind of got caught a little by surprise by this. I believe from some of your recent writings and some of the charts you sent me that this regime shift that you're expecting is rooted, at least in some part, in the petering out of these positive net liquidity flows. Is that accurate?
Yeah, I mean that's certainly what's happening, I think, at the moment, and there is a lot of other things that, if you like, have been going on under the surface that kind of like positive feedback loops, which are self-reinforcing until they're not, and then when they become negative feedback loops, they become self-unreinforcing, and you can have things can spiral relatively quickly. So I think that the risk is we're at one of these periods right now, and certainly the liquidity conditions are something that's a big part of that. So, to be specific, what kind of happened is the Fed came along, it did its 500 plus basis points of hikes, and they'd start to do quantitative tightening, and it was easy to get very bearish because it was a big fastest rise in rates we've seen in some time, in decades, and the Fed's balance sheet was going to be contracting. However, that's not what transpired, because we have what I call the Treasury pivot came along, and essentially the Treasury, Janet Yellen, pivoted Treasury issuance towards bills. And that meant that the sort of $2.5 trillion of liquidity that was idling at the Fed's reverse repo facility, that was able to be used by money market funds. So essentially they were able to fund the government and have no ultimate impact on reserves. So, I was looking at this today. Quantitative tightening has been going for, I guess, best part of 2 years, and yet reserves are higher by about 400 billion. And even though the balance sheet itself has contracted, but reserves, which are really the kind of lifeblood of liquidity, that's kind of really what matters as far as asset prices goes, is still higher. But we're at the period now where I think that's going to start becoming very challenging. So I think reserves are not going to keep climbing now. I think we're definitely in a downwards phase, and you're going to see greater kind of resistance for asset prices as the reverse repo continues to fall. So only this week, it fell to 327 billion, which is the lowest it's been in 2 years. It's bounced back up a little bit, but really, people were like, "This is all about tax payments. It's tax repayment season." But I think this is a classic case of when something's a telegraphed non-risk, it actually becomes a potentially quite pernicious risk just because everybody's guards are let down. And the general theme is there, like the RRP is falling, and the closer that gets to zero, at the same time you've got ongoing quantitative tightening, which will continue on net, eating up reserves. It means you're getting to that point where you can suddenly have a funding problem, and that also then leads to the higher chance of rate volatility, which bleeds into, we can get into more detail in this, and a higher chance of equity volatility. And higher volatility, it doesn't have to, of course, because it's a symmetrical thing. It tends to lead to lower asset prices. So that's why I think we're in this potential, sea change where certainly at the very least, asset price, if they are going to keep on rising, the rise is going to be a lot bumpier and a lot choppier.
Okay, all right. I want to pull up a couple of charts here that you've shared that are related to this. One here is, as you were talking about, we entered this period of quote unquote Fed tightening, which made a lot of analysts like you, a year ago, kind of bearish on the prospects for the economy and the markets, perhaps, and then that got all offset by the fiscal side of things, as you mentioned here. So got a couple of charts related to what you're saying, what you just said, but anything in particular you want to comment on here?
Yeah, I mean, this is, I should probably explain the header here. So last Fed meeting, the usual kind of industry that we're all involved in, but people were focused on the Fed, the specifics of what they're going to say, parsing the language and the dots and etc. And there was a famous experiment done, several years ago, where they got volunteers to watch a game of basketball on video, and they said, like, count the passes. Malaski at the end, how many passes have been made? So everyone counts the passes. Now at the end, they say did anyone spot the gorilla? Because halfway through the action, a guy in a gorilla suit kind of strolls through, and almost no one spots the gorilla, right? They're so focused on the action in the game, and nobody believes it. They have to rewatch the video, and they go, missed this gorilla. How the hell did I manage to miss this gorilla? And it felt like that with the Fed. Everybody's so like parsing the language and counting the dots, but the gorilla is really the fact that conditions and ultimate, totality of monetary policy was actually very loose. So the chart there, I tried to capture that because it's not just the Fed's rate. We also persistently, the market has been trying to price in cuts. Right? So the belief being that the economy can't take higher rates. So as soon as the Fed were trying to jack up rates, the market, down the line, maybe 3-6 months, was pricing in cuts. So that kind of takes some of the air out of the Fed's tightening. And then on top of that, we've had this, for most of the last year and a half, we've had this asset rally. You've had volatility falling, assets, equities rallying. That's led to this massive loosening in financial conditions. And Goldman Sachs Financial Condition Index is calibrated such that it's meant to relate to a change in the Fed rate. So you can put these three together and you can kind of come up with like an effective Fed rate, so the actual Fed rate, the spot Fed rate, plus what's priced in over the next 12 months, plus the financial conditions index. And you can see in the chart there on the left-hand side, despite the fact that rates rose, we saw a tightening to begin with, but then we saw a massive loosening. So that's really like an incredible loosening in the totality of monetary conditions, despite, 500 basis points of hikes. Not to say conditions are, by the way, outright loose, but they are exceptionally loose relative to the fact that we've hiked 500 basis points and the Fed has been doing quantitative tightening. And furthermore, the chart on the right there, if you look at how that happens, around the last Fed cut, or before the first Fed cut, you tend to see that loosening. You've never seen as much loosening before, basically. So the blue line is what's happened over the last 40 weeks or so. The white line is in and around the first Fed cut. So really, it's a very atypical environment that we're in, and this has led to this what people have been able to kind of hard to believe that market has continued to rally, until recently. Bonds continued to rally too. Yields been much lower than expected, despite these very tight conditions. So that's really one of the other reasons that's fed into the fact that why recession risk is not as high as it probably otherwise would have been, and we can again get into this in more detail, why inflation is still elevated, why it's sticky, and why it's almost certainly about to reaccelerate again.
Okay, we're going to get to inflation in just a second, but this goes a far way to explain why the balloon of the economy and the markets has magically continued to rise, even though the Fed has been basically tying anvils to it, right? So you have this other chart here, sort of related to this, but you're saying, well, I guess here we get into the inflation side of things a little bit. You're saying here, if this is what tight monetary policy looks like, what's going to happen, if we end up loosening and we have this sort of, as you said, sticky inflation. I assume if the Fed starts cutting and has a true pivot and inflation's not tamed by that time, that's a real concern that it could flare back up again, correct?
Yeah, exactly. And that's what I believe what's been happening with yields lately. It's like belatedly getting the message. I mean, at the end of last year, if you look at proxies of bond positioning, so you can't look at the commitment of traders positioning for treasuries because it's distorted by the basis trade. However, you can come up with sort of various proxies measures, and you can also look at the JP Morgan client treasury survey and things like that. And it's clear, like towards the end of last year, there was a big long in bonds, right? So I think people were hedging against recession. So I've got two problems with that. First of all, all the stuff I was looking at was saying there was no near-term recession risk. And again, we can look at that in a bit more detail later too. And second of all, in an inflationary regime, bonds are not really a recession hedge anymore because you can have a growth and an inflation shock at the same time. So, as is typical in this new kind of regime that we're in, I think people are still working off the old rules of thumb. And the old rules of thumb are irrelevant now. They're kind of extinct for now. And they're going to lead you astray. So, yeah, absolutely. So we have this situation where no recession, plus inflation, it looks like it's coming back. It's certainly sticky. And the question then is, why would you want to own treasuries? In fact, you can make a very good case. Why wouldn't you short them? And so if you look at, again, the JP Morgan client treasury survey, you look at the net shorts, virtually no one was short. That's changing now. But really, as I say, this environment is very conducive to higher yields, and nothing moves in a straight line, of course. So, already bonds have sold off a reasonable amount. Last I looked, 10-year yields were at 465 or 463 or something like that. People will continually try and nibble on them. They'll see value. But I think even if you look at some of the recent auctions, last week's 10-year auction was terrible. So maybe there really is, the wind is beginning to change. And you got to remember, like, unless you have to own treasuries, like your liability matching, well, again, why would you own them, right? No recession or no imminent recession, elevated inflation. It's not a recession hedge anymore. And on top of that, because stock and bond correlation is now positive, it's not really a portfolio hedge either. So you're kind of running out of reasons as like a multi-asset manager as why you would own treasuries, right? And that's why if you look at on net over the last year and a half, the only sector that's on net been buying treasuries is the household and corporate sectors, basically the household sector. The Fed obviously hasn't been buying treasuries. Foreigners have not been buying treasuries, and the financial sector, banks have said they've only just started to buy treasuries again. So you kind of like the buyer of last resort has become the household sector, and the risk there, of course, is the household sector. I don't think they pay attention to break evens, right? Break evens might be well behaved, but and maybe they're, I don't know, 2.5 for like 10-year. But if the household sector is going to base its what it demands its yield on longer term inflation expectations, which is more likely, and you've got Michigan inflation expectations are towards 3.5%, that's already like a percentage point more that in theory the household sector should demand for holding treasuries. So there's definitely a lot more upside here, just in terms of like who needs to own treasuries, and if you are going to own them, what kind of risk premium you're going to demand for holding them.
Okay, so this is an interesting topic because it's one where I see a fair amount of, I would say, disagreement with the different folks that I interview. There are some that are on the ride might be a little bumpy here for a little bit, but disinflation is going to win out, and usually that argument is based upon current changes in the money the money supply. So these tend to be the economists, the Lacey Hunts, the Steve Hankes. They're using formulas like the quantity value of money. And to them, it's just sort of a inevitable math issue. On the other hand, there are people that are looking at sort of potentially secular macro shifts. They're certainly looking at the current data that's showing that in the near term, it's sticky. And you've got a chart I'm going to see if I can pull up here that shows that, well, first off, you've got this chart here that shows that umbrella inflation is continuing to rise. And maybe you can talk just for a second about what umbrella inflation is and how that differs from, say, the headline CPI that we see.
So what I was trying to do there is essentially we have multiple different ways of measuring inflation. And like a lot of market analysis, there's a very much element of pick and choose what indicators you want. There's probably an indicator out there you can always kind of find to suit whatever your view is, and or whatever your narrative is. So you've got sticky inflation, you've got median inflation, you've got core inflation, you've got PCE, you've got break evens. So that's simply just a measure to it takes the median of a whole bunch of inflation measures. So it's kind of trying to be ecumenical to all inflation measures.
Got it. Okay, you're taking all the different ways and saying if we munch them all together, this is where it comes out.
And just take the median, right? So you've not got any skew effects. You're just taking a straightforward median, and you can see there that not only is it turning back up, but it's turning back up from a higher level. So it's kind of getting hard, however you slice it and dice it, to say that inflation is not an issue and it isn't beginning to become problematic again. But the other big point I'd make here is that it amazes me. There's a huge amount of analysis done on inflation, but inflation is inherently backwards looking, right? So already it's telling you something that's already happened, right? And most of the analysis focuses on, first of all, going into like the components and slicing and dicing them. You're not going to get any extra information really from the components, right? They're not going to tell you anything that the headline number isn't really going to tell you. There's no extra information embedded in these components. And second of all, people will say, well, we'll take the last 3 months and then annualize it, or take the last 6 months and annualize it. And that, again, you're not adding any extra information, right? There's a little bit of autocorrelation, right? So inflation does have some sort of self-movement relation, but by and large, there's nothing leading in that. It's not going to tell you about a turning point, right? Because all the information is embedded in something already there. And if that's not turning, then nothing in forward is going to turn either. So you really need to look at inflation and find things that actually lead it. So things that if I have a chart with 2 lines, I can push forward the leading series that's actually ahead of inflation and tries to represent what the turns in inflation are going to be. So it's trying to get the turns. You're not so much about magnitudes. I mean, they're not that important really at the end of the day. If you think about it, risk assets don't really, if I say inflation is going to be, we think it's going to be 3 and it comes out 3.3, probably doesn't make a big deal of difference in the grand scheme of things, but it's the turns. If there's a sudden change in direction that the market's not expecting, that's when you get the biggest changes in risk assets, because if you like, it's at that point, people tend to linear extrapolate. And so when you get the turn, that's when the predictions are most wrong, right? Because the extrapolation's going up that way and the curve's sort of going down that way. So you get the biggest gap, and that's when people get most surprised, and that's why risk assets tend to move the most. So that's why turning points are really much more important than magnitudes. So, I've been looking at a bunch of leading indicators for inflation rather than try to focus on just the number itself, which is, as I say, inherently backwards looking. And a number of them have been turning up. And it's not just like 1 or 2. You don't look at one indicator and go, hey, that one's turning up. So as far as I'm concerned, inflation is re-accelerating. You want to get multiple confirmation. And that's essentially what we've had. So for instance, the supply pressures had started to pick up. So the New York supply pressure index had started to pick up, and that's still rising, is still elevated again. And obviously, we've had some real world examples of that, like the skirmishes in the Red Sea. We have rising inflation expectations, both consumer and business. These also tend to lead inflation itself. We've seen rising profit margins, and that's something I think is very different about this inflation cycle than the 1970s. The 1970s was a inflation wage spiral, wage price spiral. Profits are going to be part of this. I think we're going to have a wage profit price spiral in this cycle, and profit margins are really again elevated, and they are not showing signs of turning back down again. Wage growth is leading indicators of wage growth are stable, but wage growth is growing positively in real terms. So that in itself does feed into inflation, right? When you've got wages rising in real terms. And finally, the one that's not come through yet, but I think it's just a matter of time, is China. I mean, I think that's really the elephant in the room when it comes to why the Fed managed to get any disinflation, despite the fact, as I said, conditions were actually really loose. Wasn't because of the Fed hikes, it was despite the Fed hikes. It was because China was the only country to experience outright consumer deflation over the last few years. I think that's had an enormous influence on why we got much disinflation at all. I would say, I'm picking numbers out here, but I have tried to measure it more accurately. But I would say something like about 70% of the disinflation probably came from non-Fed effects, probably mainly China. Maybe only 30% has come through from the direct effects of Fed hiking and tightening policy.
Okay, and what do you see happening with China going forward? Are they shifting back into a more, inflationary regime?
It's stop start. So I hesitate. It looks like it's going to be doing this for the last 6 to 9 months, and it's still it's hard to sort of be unequivocally sure. I mean, at the end of the day, look, it's at the point now where there's been deflation for so long. You are beginning to see incrementally all the stimulus that they've added very slowly beginning to have an effect. But the thing to watch is really real money growth. And that's through fits and starts. It's shown some signs of life, but it's still, unfortunately, it's not at a point now where you can say unequivocally we're there. But it wouldn't take that much. I think we're at the stage there where it wouldn't take that much. And again, we've already had this re-acceleration in inflation, or certainly at least stickiness, right? And that's before there's been any impact from China. So I think China coming in right now would really sort of give things that extra boost. And that's, again, when I say that inflation is going to re-accelerate, I mean, I'm not talking about a new peak here and like that. I think conservatively you could say, or realistically you could say, maybe we get CPI back up to kind of a 4-ish level. in the not too distant future. But the thing is, once you're at 4, people are going to be thinking, well, what if it goes to 5, right? Or what if it goes to 6? So your risks kind of curve shifts as the price moves up. So I think that would kind of put the cat amongst the pigeons a little bit. And really, again, assets are just not priced for this at all. I mean, yields are beginning to incrementally maybe try and reflect that reality. And obviously, we've had gold and silver rallies lately, and you can maybe argue Bitcoin is partly about inflation fears. But you really haven't, assets are really not pricing this at all. So I still think there'd be a significant repricing ahead if people started to really sort of think this is something similar to the 1970s again.
Okay, and I want to talk about your market outlook and that potentially significant repricing. Before we finish inflation, though, I'm sure there are people listening to you right now feeling like, yeah, I don't really want to be hearing this, Simon, right? Like we've been beaten up by inflation. We were kind of hoping that we were getting through this. I'm going to pull up a chart that you recently created, which basically is showing how all these different asset prices have reacted so far to the inflation that we've had, and you've basically divided them into 3 areas. One is assets that have behaved about as much as we would have expected given the inflation we've seen. Some that have outperformed in price, I believe is how you're looking at this, and those that have underperformed. So if I'm reading this correctly, does that mean that you think if we stabilize here, right? Let's say we just hang out at 4 going forward, or 3.5, 4, that we should expect to see cars, clothing, commodities, food, and tips appreciate in price?
Yeah, that's exactly what I'm trying to say here. So trying to basically or identified inflation regimes, first of all. So I defined an inflation regime. So qualitatively speaking, it's elevated inflation that's persistent. Quantitatively, I defined it by looking at various moving averages and inflation volatility. And then that gives us 5 distinct regimes. So 3 regimes in the 1970s, 1 in the late 80s, and then the most recent one, which ended March 2023. So then I looked at what the average performance was of all these sectors and assets through these 5 regimes. And then what I did is looked at what their performance has been since last year. So essentially their year's performance, and then compared the 2. And exactly that. So the ones that kind of, if you like, have the most catch-up potential are, the cars, clothing and textile sectors and commodities, and then food and tips as well. They have the most catch-up potential compared to previous inflation regimes.
Just to interject, but I'm sure there are viewers here saying, oh God, Simon, you tell me my grocery bill is going to get even more expensive? Sounds like you're saying, be prepared for that potentiality.
Yeah, I mean, leading indicators are already showing that. So, for instance, if you look at something that leads food prices very well is fertilizer prices, and they're already beginning to rise. So it looks like, food prices are going to start rising again. Obviously, that's, depending on who people are, obviously it has a bigger weight in their shopping basket. Over in the actual CPI basket, it's not huge. I think in the US, it's maybe 7 or 8% or something like that. But yeah, I mean, obviously from an individual perspective, it can be costly. And it looks to be that way. And this is the thing. I think once inflation genie's out the bottle, things start to be less in sync. And then, so some things start slowing down in price, but just as other things are turning up in price. And really, I think that's at heart why inflation kind of comes in, if you like, waves, or certainly once it goes above a certain level, you're likely to see it kind of persist. And that's because I think all the signaling mechanisms become out of sync. So when inflation is kind of low and stable, things don't vary enough for things to get too out of whack, and therefore everything can kind of stabilize and converge. But once, as I say, the genie's out the bottle, then you don't really get that. So you can end up with different prices at different times moving around, but the net effect is you tend to get higher overall inflation. These are equity sectors. I have the caveat with the cars one. I mean, that's basically just been Tesla. So over the last 5, 6, 7 years, that sector has basically been moved around by Tesla. And at the other end, the bottom. So these are the ones that kind of outperformed the most, and they're kind of intuitive, like IT and retail certainly. So we know that they've had like gangbusters that rallied like 60% or more in the last sort of year. But they tend to underperform in inflationary regimes. So, if history is a guide, then you'd expect to see these sectors really begin to underperform if we, as I say, I believe we will re-enter another inflation regime. And again, it's kind of intuitive because retail and infotech, for instance, are very high duration sectors generally. And these are the sort of sectors that tend to do less well when inflation is elevated.
Okay. Now, obviously, this is where a lot of investment capital is in a lot of these areas, right? You've got the 60-40 portfolio allocation there. You've got, value there. I guess one thing that might make people scratch their head is to say, well, why is gold in there, right? If gold is quote unquote traditionally an inflation hedge, is it just because gold's run up in price so much recently, or is there another reason why it's in there?
So the gold is, really over the longer term, it's not actually a good consumer inflation hedge. So this long-term correlation with CPI is basically zero. So it happens to be going up right now. Well, we maybe have a bit of an inflation issue, but in terms of the two series together, like certainly on a coincident basis or even on a leading basis, there's no real long-term link between gold and inflation. And I think that's because gold actually serves many functions. I see it more as a financial insurance, insurance against the financial system, and secondarily as an inflation hedge. But unfortunately, it's an investable asset. Therefore, it's subject to speculation, and therefore it can sometimes do the complete opposite, if you like, of what you think it's supposed to do. Like 2008, it had a huge sell-off initially. You'd like to think that's exactly when an asset like that should be performing, but a lot of the market is paper market. People needed to, they were leveraged and they needed to sell to get margin, and obviously it pushed the things down. So the way I think to approach gold is to buy unleveraged, and preferably not through the paper market, to have physical gold allocated, so it's not rehypothecated. And then I think gold will do what it's supposed to do, which is preserve, purchasing power. But from a market perspective, it doesn't always do what you think it's going to do purely from a price perspective. And again, lately we've seen that even more like magnified with silver. So silver's had some pretty wild moves lately, as tends to happen, because it's kind of seen as a bit of a catch-up trade. So I think people that missed the boat on gold then look to silver, but silver's considerably smaller market than gold, so it can really rally, like 2011 massive rally, and then back in the Hunt brothers corner, you saw an extreme rally there as well. So I think that the reasons are ultimately sound, but I think it's overly simplistic to think of it as just as an inflation hedge.
Got it. And I think you're also saying it may be overly simplistic just to look at that chart I showed and said, oh, it's in the it's in the overperform category, therefore gold's going to not perform well going forward. Nobody has a crystal ball, but here's one of your charts you sent over, which I'd actually love for you to talk to, because this question's come up a lot recently. Well, you're saying there's actually some conditions that are in gold's sweet spot right now, meaning that it may still go higher from here. But people have been looking at this divergence between the price of gold and real interest rates. And, I think that's one even more than people who have colloquially said, oh, gold's an inflation hedge, as they've said, oh, gold and real rates move in tandem. And so that as real interest rates, have an inverse relationship. As real interest rates rise, price of gold should go down, vice versa. That correlation you can see from the bottom chart here on the left, at the start of your data series here in 2006, it's been very tightly correlated right up until the past year and a half, and then they've really diverged. So explain why you think that's happening, and why you think that still might be kind of Goldilocks conditions for gold here.
Another good question, because as you say, this chart has been doing the rounds, and I tried to faithfully recreate it, and there's a sort of a bit of a caveat here, or sort of a warning, I guess, with charts like this that almost look too good to be true. So you can see it's got two axes, one in the left, one in the right, and really that you have to kind of play with the maximum minimum sizes to get it to look that good. Now, it's not to say the relationship is there. Like basically there was essentially a negative correlation between the two, and now there's more of a positive correlation. But the chart, I would say, is kind of a little bit misleading in how much that's changed. But really, it gets to a broader point because it's another rule of thumb that isn't actually the case. So the rule of thumb is the general belief is that real interest rates are negatively correlated to gold, and something called Gibson's paradox, sorry. And Keynes have called it a paradox apparently because it contravenes standard economic theory. So he gave it the name of paradox. And as Gibson's rule, which is essentially for every percentage point real interest rates are below 2%, gold should rally 8% over the next year. But like a lot of these rules of thumbs, they kind of fall flat when you actually look at the data. And actually, if you look at the relationship to real interest rates and gold, it's more parabolic. And that's what I've tried to capture in the right-hand chart. So what I've done there is just bucketed the real rate. I've just used Fed rate minus CPI, and then looked at the subsequent average gold performance over the next year. And you can see there it's actually like at very negative and very positive real rates. Gold tends to be negative. Historically, it's been negative on average over the next year. And it's really in between minus 2% and plus 2%. That's the kind of sweet spot. So when you have real rates in and around that region, that tends to be best for gold. And that's kind of what's happened this time, actually, because, if you look about 12, 18 months ago, that's real rates were in that sweet spot. And gold is now up like 30% or so in the last year. Right, we're actually right at the right-hand side. So actually, until the latest inflation print came, we were where the red circle is. So we'd just gone over to the right-hand side. So real rates were just above 2%. But now the next inflation data came out. We're actually now back just in the sweet spot. The specific numbers don't matter too much. But if you believe, and as I say, like I do, that inflation is going to stay elevated, and if not reaccelerate, then we're kind of going back into that sweet spot again, right? So we're going to be in that situation, which is still conducive for gold. But something like this you have to take into account that's already up quite a lot. So it's not just going to keep rallying, but it's telling you that despite what the shorter term relationships would tell you, that from the chart on the left about the flip and the correlation, it's a little bit more complicated than that. But it is telling you that real rates are still at a point where they're not going to be non-supportive for gold prices. So I think gold is always going to be subject to selling off when it's overbought. But I definitely think that the overall backdrop, as I say, when you look at financial risk and combine them with the real interest rate, not specifically inflation, but just the real interest rate, that's pretty good for gold.
Okay, so let's talk about financial risk. I'm looking to pull up a couple of other charts that you have here. Let me see if I can just get them prepared here. All right, here's the first one, which is that the number of stocks with low RSI is picking up here. So this basically is a measure that things are getting played out, correct?
Yeah. So this is shorter term measures of breadth, really just to give a flavor of, we're in this period of the market that's now facing more resistance. And so I wanted to show in these charts that breadth is clearly deteriorating, and but it's not at the point where we're at capitulation. So breadth is often a contrarian measure. So it's when things are very extreme, you kind of want to do the opposite. So that low RSI number, when it became extremely high, there was like lots of stocks with a low RSI. That's usually telling you that there's some sort of short-term bottom. But when it's kind of moving up from a low level, that's telling you that things are kind of deteriorating. So, we're in this period right now where things are clearly getting worse for stocks. Breadth is kind of breaking down. And, it's not, certainly from a breadth point of view, there's no obvious reason why it should bottom right now. But it's, we're clearly facing more resistance. And I think you had another chart there which showed that breadth was related to yields. Yeah, this one. So actually, over the last year and a bit, or almost a year, it's been quite a nice negative relationship between the percentage of stocks over their 200-day moving average in the S&P and the 10-year yield. So we're a little bit to the right. You can see there right now, but that sort of suggests that if that straight line relationship held, breadth should already be lower given where yields are. And if yields keep rising, that's going to be bad for breadth. So that's giving you like a short term outlook for like how stocks are behaving right now. And I think it just bears watching, right? It bears watching, how significant is the deterioration, and that gives you maybe some clue about how long the sell-off is going to last. But as I say, when you combine with the liquidity backdrop and the volatility backdrop, then we're clearly in a bumpier kind of transition phase for stocks. And I certainly think that the easy rallies, if you like, of last year and maybe even some of the beginning of this year, that's kind of gone. So it's not to say the market isn't still in a primary bull trend. I think that is the case, but the returns are going to be much harder to come by, and it's going to be a lot easier, a lot harder ride. The good thing is, though, that hedging is still relatively cheap. So, if I was running a portfolio, I definitely would want to be hedged right now, just because why wouldn't you? I mean, you've got abundant risks and you have fairly relative ways of hedging those risks.
Okay. I want to talk just a little bit more about those risks. And here's one slide I meant to bring up earlier, but you just talked about what's happening on the liquidity side being a factor here. So this is the reserve impulse, which is basically the rate of change in reserves, correct? And you're saying that it's currently in contraction, and that at least is in the short term is going to be a headwind to stocks, correct?
Yeah, it's another short-term indicator. So it's the change of the change. So the second derivative, if you like. So the 1 month change of the 1 month change in Fed reserves, and that has pretty good relationship with the 1 month change in S&P. So kind of short-term S&P. So that really nicely captures this short-term reserve liquidity kind of issue that stocks are facing right now.
Okay, and then as you're saying, we're seeing some of the weakness in the market right now. The rocket ride we had in Q1 clearly has plateaued and is kind of experiencing a fair amount of turbulence right now. In there, you're saying that we're seeing a lot of technical signals that all is not well. One of them is the Hindenburg omen, and maybe if you could describe to folks what that is. It's basically a ratio of stocks hitting their 52-week highs versus 52-week lows. But anyways, we're seeing, looks like more of those now that we saw back prior to the dot-com bust.
Yeah, it's kind of curious, this one, because I saw it, and obviously it looks, if you take out context, it's quite an alarming chart. But again, you've got to be careful. Like, first of all, it's just one technical indicator. And as you say, it looks at the percentage of stocks making new 1 year highs and new 1 year lows, and also the index has to be near a 1 year high as well. So obviously we are still near a 1 year high, and we're seeing sort of rises in both the percentage of stocks making new highs and new lows, and each one of these is a Hindenburg omen. And then I add them up over a calendar year. So yes, the chart there has shown that we've got the most in a calendar year period since the 2000 tech bubble. But there was one other time, it's not on the chart, the mid-90s, where there was more, and that was in the middle of a bull market. The market kept on rallying. I think that as much as by the way, I've been talking about the Fed liquidity backdrop, that's a short-term headwind. The slightly more medium-term outlook for liquidity is still relatively good. So in a medium term, I look at liquidity, I look at excess liquidity. And excess liquidity is the difference between essentially real money growth, which money is created by banks and central banks, and between economic growth. And that difference between these two, if you like, is kind of liquidity that's excess to what's needed by banks, what's needed by the economy, and therefore it can find its way into risk assets. So that's still supportive right now. That's something that I'm definitely keeping an eye on. I think that's one of the reasons why I think we're still going to keep in this primary bull trend, is because there's still no imminent recession, and we have these supportive excess liquidity conditions. But the short-term picture is definitely murkier, and this Hindenburg omen, I think, is just one example. Like, you'd be remiss to ignore this altogether, but you'd also be folly to obviously just go in and sort of say we're at the 2000 top just in the back of this.
Got it. But it's just an indicator of rising risk, I guess maybe is a way to say it. Doesn't mean the market's going to roll over tomorrow, but
it's telling you that things are afoot, if you like, underneath the market, as well as from a liquidity perspective.
Okay. So what has driven a lot of the market's performance over the past year has been the whole AI exuberance, right? And obviously that's been driving the NASDAQ because most of the big companies that are in AI are in the NASDAQ. I'm not saying necessarily it is, but if the bloom starts coming off the rose of AI and its ability to deliver the benefits everyone's hoping for from it, or deliver those benefits soon enough to justify today's valuations, what impact do you expect that to have on the market?
Yeah, I think I mean, I've been thinking about this. It's hard to see how, we could have a smooth rotation, if you like, away from tech towards some of the more undervalued sectors like energy. I mean, I think that's kind of the way you want to be positioning right now anyway. And I've been saying that, I think, for a few months, is the undervalued sectors, the low duration sectors, and they've been very unloved certainly till very recently, and then the over ebullience in some of the other sectors like retail and tech. So I think there's a huge amount expectations built into tech and mainly AI. And I think that I agree with you. I think it's AI can deliver a lot. I think that the current generation of AI, which is all based on large language models, probably will not deliver a lot of what people think it's going to deliver. The only thing that might, if you like, get lucky is that before that's kind of realized, maybe there's another iteration, another type of AI that maybe does have a lot more potential, to say, leading towards actual artificial general intelligence. LLMs are almost certainly not the way you're going to get there. And I think more people are using LLMs for a bunch of stuff. They're realizing that there's like these edge cases, like 3% or so, but the edge cases become really important. I think that's what did it for self-driving, or not what did it, but what's done it for now is that, great, it works like 97% of the time, but the 3% it doesn't is really important. And that's kind of put, self-driving back a little bit, and they might encounter the same issue with large language models. So, as I say, I don't think people have really maybe understood their limitations, or they've overexpanded what they think they're capable of doing. And again, that's not to say, I mean, there are a huge elite, but it's a case of what's built into expectations, and as you say, how quickly people are expecting those things to happen. So there's that reason why you could see tech, beginning to the air coming out of tech, but the inflation thing as well, I think, is big as well. I think higher duration stocks will go out of favor in a sort of elevated inflation environment, and especially as I say, I don't think people have been pricing. It's not so much they're not just pricing, inflation's back at 3. I still think people are anchoring to 2 or 2.5 or something like that. I don't think there's still been a sort of widespread realization that really this is a different environment, and we better get used to sort of elevated and persistent inflation for quite some time. And when that repricing happens, I think all of a sudden people are like, right, I really don't need to own bonds here if I don't have to. Things like commodities and other real assets start to look much more attractive. Duration in any form begins to look much less attractive. And I just don't think we've sort of reached that point where people have significantly really changed or think they need to change what they do. So yeah, I do see tech as vulnerable, and again, it's everything's price related, right? But it's obviously some of the valuations are quite extreme for tech. So price to perfection, it wouldn't really take much of a disappointment for prices to sort of correct somewhat.
Okay, help me understand one conflicting narrative, which is in periods of inflation, I think people say, oh, well, you want to get into tech because it's a growth industry, right? And it hopefully can grow faster than the rate of inflation. Where there's another argument, which you just made, which is, you don't want anything with a long duration, and because high growth tech companies generally don't pay dividends, they're oftentimes looked at almost like a zero coupon, type of instrument of like infinite duration.
I mean, I would just go back, as I say, to how it's behaved, historically. If you go back to the table that we looked at, it has tended to underperform. And I think obviously people will make the argument like this time is different, but you can always make the argument at the time, this time is different, in that things will behave differently to how they expect. So again, if I had to go by, do I think that ultimately, even at these valuations, and even if we persistent inflation gets back above 4%, maybe it's going to go higher. And tech companies which have already performed quite well, are going to carry on performing. It just seems less likely to me. And I'd have to be really confident in the specific companies I held. That'd be different, of course. But in terms of as a sector, I'd be likely just to take the outsider point of view, which is that they tend to you do less well when you have inflation is elevated. And as I say, that applies not just to tech, but a bunch of other like consumer discretionary and things like that are also higher duration.
Okay, all right. So if I took good notes here, I've heard that you, in the short term, near term, still remain somewhat bullish. Let's call it guardedly bullish. But you have said, look, it looks like we're entering into a higher for longer inflationary period, and markets are just not priced for that for all the reasons that we talked about here. Also, interest rates, yields are rising, right? And so higher for longer in terms of just cost of debt and how that pulls down on the economy and profit margins and the potential arrival of the lag effect, which I talk about all the time. Sounds like you think those are going to contribute to a bumpier ride for markets from here, and it sounds like you think if we do indeed enter this inflationary era for the near-term foreseeable future, you think there's going to have to be some sort of correction in the markets. Do you see it as just a bumpy ride, kind of up and down? Maybe we finish the year where we are right now, but there's lots of volatility, or do you see like literally a repricing where there's some notable discount that the market is forced to take?
I think we will proceed with more volatility, but always with the potential for potholes in terms of corrections, because the underlying dynamics, as I say, where we've had this kind of I called it perpetual motion machine for stocks, where low volatility is fed off, higher inflation leads to higher rates, which leads to I won't go through the whole process, but believe it or not, higher inflation tends to lead to lower VIX. Then you've got people coming and exploiting the fact that volatility tends to be falling by things like dispersion selling. You have the specific dynamic of the Magnificent Seven, which is causing implied correlations to drop. That also helps to keep volatility low. Volatility as a measure is fed into credit spreads. Credit spreads are thus repressed lower because implied volatility is low. Credit spreads obviously feed back into your equity price, which then you've now got equities rising or generally have been rising, and you've got lower volatility, so the risk-adjusted return is improving. That sucks more money in. And then you've had rate volatility at the other side, which has also been declining. And that also feeds into keeping VIX, the implied volatility, low. So everything has kind of been nicely operating. And when we start to get like something happening, as in like a belief that, say, inflation is coming back, and that's what's been reflected in yields and stuff, that has a risk of everything unraveling and running into a correction. But as long as I would say that the near-term risk of recession is low, and I still believe it is based on what the NBER looks at, and also based on leading indicators for those indicators themselves. Until that happens, I think that this primary bull trend remains intact. And I think one of the questions that you touched upon earlier, which I think is really important. Now, I will always say my risk of a near-term recession. The reason why I say that is because really, people will talk about their 12-month or 2-year recession forecast. There's nothing I've ever seen, any reliable leading indicators or signals or anything that can really give you much more of a 3 to 6 month lead that a recession is highly, highly likely. And in fact, the recessions don't tend to sort of go from the economy doesn't go from having a kind of a very low chance of a recession to kind of a medium term to like a high. It doesn't do it in a linear fashion. Economies tend to go from non-recessionary to a recessionary state in a highly non-linear fashion. So really, you don't get much of a heads up, right? You're really talking about 3, maybe 4 or 5 months, really, before you can sort of very confidently say a recession is on the cards now. So you're obviously, your window is moving constantly. So my window right now, I can be reasonably confident that in 3 to 4 months, we won't be in a recession. And by the way, I don't mean the NBR is going to have called one. That's always lagging. I mean, we actually aren't in a recession in real time. I would say I can fairly confidently say it within certainly 3 to 4 months, we shouldn't be. But in 3 to 4 months' time, that of course could change. And as soon as I see that changing, right, as soon as I see the fact that, okay, this is beginning to look recessionary, then I think that's the real sea change would happen, because you have all this other stuff that's always at risk of creating a correction, the lower volatility and cross asset volatility and all that. But then, through time, the biggest risk for equities is recessions, right? That's when they face their biggest drawdowns. So then you would really be at the point you're like, okay, so this is the point where we have to be wary that the primary bull trend is about to end at some point as well.
Got it. Gosh, I could keep going for another hour here with you, Simon, but I'll start to wrap it up. But I'm just curious, do you have an opinion on the employment data versus the official employment data versus other data like layoffs, war notices, stuff like that? There seems to be a lot of head scratching going on right now when the BLS numbers come out. One, because they always get revised, right? But also even some of the BLS's own surveys kind of don't seem to square with each other when you compare the establishment and the households. But you look at things like initial claims, which are kind of flat. I mean, like tabletop flat. In fact, Jim Bianco just recently tweeted out, looking, I think, at like 5 of the 6 past initial claims numbers have been the exact same number. So
it's almost China-like.
Yeah, it's almost China-like, right? And I guess where I'm going with this is there seems to be, a not uncommon condition where people are saying, look, I'm looking at these official numbers that are telling us that everything is great, right? And there's still more job openings than there are applicants, and so job market's super strong. But then there's all this anecdotal story. Well, there's the data I talked about, but then there's also a lot of anecdotal story about people just talking about how really hard it is to get a job right now in the economy. So could the labor market be in a worse position than the headline dashboard numbers we're looking at here?
I think I'd make 2 points. I think so the biggest divergence has really been the establishment survey, like payrolls, and the household survey. And then, as you mentioned, claims as well. But I'd say probably the truth is somewhere in between the two surveys in terms of the actual health of the jobs market, because payrolls has had a big impact from essentially you have a very low response rate. So I think that the models that kind of fill in the gaps, if you like, things like the birth death model, are having to do a lot more work. So I think that's something that subsequently we find out, which will be reflected in revisions, could make payrolls look less strong. And on the other side, there's been quite a lot of analysis done in the household survey that is maybe not reflecting immigration properly, and actually things look weaker than otherwise they would be if you accounted for immigration correctly. So perhaps the reality is in between the two surveys. But then really with this sort of stuff is like, what is reality? Because you don't actually know every single person that's got a job. All these things are ultimately based on surveys, right? They're samples.
Yeah.
And as far as the market goes, I don't think it matters that much, because payrolls is revised up to 2 years after the fact, right? And really, does that matter as far as the market goes, or anything really? If something's revised a year later, the market's already moved on. It's taken whatever was at face value kind of as reality. And then that reality has been reflected in prices, and that kind of becomes reality. Now, it's obviously a different situation if you're that person trying to get a job, right? That's kind of different. But the market can't be revised, but economic data can be revised and frequently is revised. So I think you kind of have to take the numbers at face value to some extent from a market perspective, because that's all we really kind of have. But therefore be aware of the limitations that they have. And as I say, the big things for me when it comes to payrolls, I would say the model's doing too much work, and therefore we may be getting inaccurate numbers, or maybe too strong. And the household survey is not really reflective of immigration, and that's another thing that could be impacting claims. For instance, maybe immigrants are less likely to sign on for insurance, things like that. So there's a number of things that could distort claims numbers as well. But again, none of the stuff that I look at that would normally tell you that this is going to lead very quickly to a recession. So for instance, like the number of states with sharply rising claims, that tends to rise very sharply, very quickly ahead of recessions. Now, actually, it was, interestingly enough, it gave a kind of its first false alarm last year, but now it's quickly gone back down, and very, very few states have their initial claims rising very quickly. So this is all consistent with an economy that's actually surprising to the upside and potentially sort of taking off again. So to your question, I think the market's kind of, the two surveys, the truth is probably somewhere in between, whatever that truth is. And the market's probably, I would say, overall kind of reflecting it correctly. I don't think it's been too bullish or too bearish in the jobs market.
Okay. And that's sort of where I was going, was just sort of your level of concern that we might be basing our decision making off of faulty instrumentation. Sounds like you're saying, look, the instruments aren't perfect, but you're not seeing a ton of additional data to say, that we're flying into a mountain in the near term necessarily.
Yeah,
okay.
nothing consistent, and certainly nothing. You have to look at, like, have we got enough data here, enough history? Can we say with any confidence that it is doing that? And so there's nothing I would say that sits in the other camp that would give you a strong degree of confidence that you're missing something from the main survey. So I agree with what you say.
Okay, great. All right. Well, look, we're continue the plane analogy. I'm going to try to land the plane here now. I noticed that the automatic lighting's already beginning to go off in your offices there in London. So shows you how we're getting late in the day here. So we got to let you go. But now to kind of the be all end all question, which is, all right. So for the road ahead that you feel you've got enough confidence, to see the next quarter or two, what type of assets do you think look well suited for that type of environment, and which ones do you think are not? If I took good notes here, you think that sectors that have been undervalued and have low duration, probably ones to look at. You're less sanguine about tech and consumer discretion going into a higher inflationary regime. What else would you add to the list?
Real assets, I think, from certainly a long-term perspective, and we're already seeing this. We're seeing commodities catching up, and even the energy sector as well. But commodities, I think I had in that list there the tips, as another real asset. I think that's something that makes a lot of sense. I would normally, as I say, things like gold and silver, right now they're very overbought, but they're always something that you want to take advantage of on pullbacks, especially in this environment. So I think that's something worth looking at. And as I say, I think right now you'd be kind of reluctantly long equities, so you'd be thinking about rotating away from the higher duration stuff, but you'd be hedged. I think you'd be definitely taking advantage of the fact that hedgers are still relatively cheap. And I guess I'd be focused on being long volatility, long cross asset volatility. So like long bond vol, but especially long equity vol, long credit vol. If you can do it, I guess long commodity vol. I think that continued volatility is going to continue to pick up across assets. Okay,
great. All right. Well, Simon, look, it's been a fantastic discussion. Again, thanks for soldiering through the tech issues at the start to the point where they're shutting the lights off you in the office now. Just a couple of quick questions for you as we wrap up. Very importantly, for folks that have really enjoyed this discussion, would like to follow you in your work, where should they go?
My stuff's on the Bloomberg Terminal. So if you have access to a Bloomberg Terminal, I write for the Markets Live blog. And I also have a column, it goes out twice a week, called Macroscope, which you can also subscribe to on the Bloomberg Terminal.
All right, fantastic. And I've got one last question for you. I'm going to ask you in about 30 seconds while I do some quick housekeeping in the interim. But that question is going to be about what's one of the biggest valuable lessons you've learned in the journey of your professional career here? Folks, as we wait for that, if you've enjoyed this conversation with Simon, would like him to come back on, particularly if his outlook begins to shift based upon the things that he's seeing in the data, please let him know to do that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And again, if you want to potentially consider putting into practice in your portfolio any of the things that we talked about here with Simon, or with any of the other experts on this channel for that matter, highly recommend that most people do it, especially heading into what may be a more volatile market environment, as Simon thinks we're heading into. I highly recommend you do that under the guidance of a good professional financial advisor. If you don't have a good one, or would like a second opinion from one who understands and takes into account all the issues Simon and I and all the guests on this channel take into account, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the short form at thoughtfulmoney.com. Those consultations totally free. There's no commitment to work with the guys. It's just a free public service they offer to help as many people as possible position as prudently as possible for what may lie ahead. Also there at Thoughtful Money, you can sign up for our free newsletter. All right, Simon, thanks so much. Back to the very last question here. You've had a very successful career. You are a highly respected analyst at Bloomberg who publishes fantastic work all the time. What's an important lesson that you've learned in your career journey so far? You know, this could be something that a mentor imparted to you. It could be something that the School of Hard Knocks just beat into you along the way. What's a lesson that you think would serve the average retail investors that are watching this program?
Well, I think I would have something that applies to both professional and personal life. And I would say one of the lessons that I've learned as I've got older is lower your expectations. Okay. I think you're more in harmony with the world around you, and you're basically a happier person. But I think it's the sort of thing you say to someone that's younger and still in the rat race and etc. that they see it as like a giving in, but I don't think it is. I think it's actually something maybe much more powerful than that. I think that it's having a sort of belief that you don't have to be consciously aware that you're doing something. Like I have to have high expectations and compare myself to other people to be successful. You don't have to be consciously aware of it. I think you have a kind of, if you like, an inner part of yourself that is going to do that anyway, and just to have faith that you're going to do it in your subconscious. And therefore, I think if you have that lower expectations, you still have the ability to do what you want to do, but with being more in tune with the world around you, and then just definitely more relaxed and happier.
I think that's great advice. Some might jiu-jitsu that and say it's like practicing gratitude, with sort of like just being happier with what you have now and where you are now. I just want to add one thought to it that I think is complementary, which is as you get older in life, and I've got more gray hair than you, Simon, you begin to see people that cross the finish line, right? Like hit their goals and whatnot, and how life is for them. And you also, see that there are people that life happens, right? And people sometimes have some horrible things happen to them that they didn't anticipate. Death being the most extreme example of that, right? So people who had lots of aspirations but are never going to get to realize them because their life was sadly cut short. So you begin to realize that we might not have tomorrow, or the tomorrow that we think we're going to have or are shooting for, and so it's important to take as much joy and happiness and fulfillment from today as possible. And the story that stands out in my mind about this for me is when I was going independent, right? When I was leaving my previous company and coming to this one and wrestling with a lot of the issues that were around that transition, I talked to one of my mentors who's a very successful business guy who has crossed the finish line in life. And, it was a period where I was feeling weighted down by some of the curveballs and the heaviness of and the risk and all that type of stuff. And I could see him in his eyes when he looked at me, and he said, "I'm so jealous of you." He said, "You're in the game right now. You're in the thick of it. And yeah, you're going to have to fight and get up every morning and go to battle." But he's like, "You're in the great game." And I could tell that after he had sort of crossed the finish line, life just wasn't as vibrant for him anymore. And when people say life is much less about the destination than it is about the journey, it's very true. And that's really what I took from that. And so to your point, like when I have days that are going against me or whatever, I try to remind myself that I've got the good fortune of being able to play the game and do my best to create whatever outcome I want. And whether it happens exactly the way I want or not, I've at least got the control of my actions and got agency in the story, and I'm the hero in my own story, no matter how the ending gets written. So you're nodding as I'm saying all this, but to me, I really sort of took that away from I didn't hear you say like, "Hey, just give up and ratchet your expectations to the floor." But it was, don't necessarily to hit a home run every time you're at bat, but enjoy the fact that you're on the team and you get to get up there and take swings. Not everybody gets to do that.
Yeah, and also maybe, when you do get to retirement and your life changes, and like your friend you were talking about, having that lower expectation thing, you might then find something that actually you do get the same feeling from, but it's maybe not what you would have expected to initially, maybe, unless you sort of lower your expectations. So it's maybe
Sure.
something that you can carry forward.
Yeah. And I mean, and that is life, right? I mean, we hardly ever get exactly what we want. And when we do, it's hardly ever exactly the way that we thought it would be, right? So life's always keeping us on our toes, and the ability to have the emotional flexibility and resilience and curiosity about life to say, well, I guess I get this. What's the most I can make from that? Huge, huge, valuable skill. All right. Well, thanks, my friend. This has been, it's always a highly intellectual, highly informative, and highly insightful discussion with you, Simon. Thanks so much for doing this. Really look forward to having you back on the program again soon.
Cool. Thanks again for having me, Adam. Cheers.
All right. And everybody else, thanks so much for watching.